All right, let's just dive right in. For decades, we've all operated on this one very simple, incredibly comforting assumption, right? Your money is in the bank, and when you want it, you can just go get it. That is the entire fundamental point of having a bank account. But right now, in 2026, that long-held assumption is showing some serious, immediate cracks. Welcome to our explainer on the new banking reality. I want you to imagine something for a second. Picture walking right into your local bank branch, stepping up to the teller, and asking for your own cash. Now imagine the absolute shock of just being told no, or suddenly finding yourself intensely cross-examined about exactly why you need it. Or, honestly, worse of all, having your entire account frozen completely without your permission, without any warning, and potentially for weeks while the bank investigates you. And look, what I just described, it's not some weird computer glitch. There are actual rules in place right now, some brand new this year, some that have just been quietly operating in the background for a while, that give your bank the legal authority to block access to your own money. Not because you did anything wrong, and definitely not because the bank is going under, but simply because an algorithm, or maybe a teller, decided your transaction looked suspicious. These automated systems are increasingly acting first and asking questions later to legally block access to your funds. So in today's explainer, we're going to cover the 4 specific traps freezing assets today. We've got Trap 1, the protection freeze. Trap 2, the accidental federal crime. Trap 3, the cashlight branch squeeze. And Trap 4, the dormancy trap. Let's look at exactly how to protect your money. Okay, let's jump right into our first one. Trap 1, the protection freeze. Now, this situation heavily targets seniors 65 and older who have investment, retirement, or brokerage accounts. The mechanism behind it is this federal rule called FINRA Rule 2165. And you really need to notice the remarkably low standard of evidence required here. This rule grants financial institutions the legal authority to place a temporary hold on your transactions if they believe, or actually, even if they just suspect, that you might be a victim of financial exploitation. They absolutely do not need proof, they only need a reasonable belief. So say you're just trying to move 15 grand from an IRA into your checking account because you want to buy a car. The automated transaction gets flagged, the firm puts a hold on it while they investigate, and suddenly, you can't access a dime of your own money. And here is the real kicker. That freeze, it can legally lock your money up for 15 business days. Not just days, business days. That is 3 full calendar weeks. And the timeline is getting even more aggressive. In January 2026, over half of all U.S. states enacted or strengthened what are called safe harbor laws. These laws explicitly encourage banks to delay suspicious transactions and give them total legal immunity from being sued for doing it. With that legal immunity in place, automated systems and tellers are way more willing to pull the trigger and just freeze accounts. So what's the escape here? How do you avoid this whole mess? Well, first things first, preemptively call your bank before making a large or unusual transaction. Telling them, hey, I'm withdrawing $12,000 next week to buy a car creates a record that the transaction is expected and intentional. This dramatically reduces the chance of a freeze. Second, set up what's called a trusted contact on your account. This is just a family member the bank can call to quickly verify your safety. They have absolutely zero access to your money, they just help resolve any investigation swiftly. All right, moving on to Trap 2, the accidental federal crime. You know, this is a scenario folks just walk into completely blind, usually thinking they're just, maintaining their privacy. Under the Bank Secrecy Act, banks are required by law to file a currency transaction report for any cash deposit or withdrawal of $10,000 or more. A lot of people know this. But what happens when you try to avoid that report? If you deliberately keep your transactions just under that threshold, say withdrawing $9,500 instead of $10,000, or making 3 $3,000 deposits over a few days, that is a federal crime called structuring. Bank algorithms are actively hunting for people trying to quietly step around this $10,000 limit, and the IRS and Department of Justice pursue these cases extremely aggressively. It's honestly a stark contrast. Making a large $10,000 transaction all at once, totally legal, completely normal. Sure, a report gets filed, but it simply means the bank followed the law. But splitting that exact same amount into 2 $5,000 withdrawals specifically to avoid the paperwork, that makes you a federal criminal, regardless of whether the money itself is completely legitimate. To put this into perspective and show you how serious this gets, consider this really sobering case of a retiree in Michigan. She regularly withdrew $8,000 from her savings, money she had earned and saved over her entire lifetime, perfectly legally. But she simply had a pattern of withdrawals that the algorithm flagged as structuring. her accounts were frozen, and $35,000 was seized through civil asset forfeiture. She was never charged with a single crime, but she still lost her money, and it took over a year of intense legal fighting just to get it back. The escape for this one is super straightforward and honestly, non-negotiable. Never break up a large transaction. Ever. If you need to make a large cash move, always withdraw or deposit the full amount at once. Just let the bank file the standard harmless currency report. Do not try to fly under the radar even if it feels simpler or more private. It is just not worth the risk.
Okay, now we arrive at Trap 3, the Cash Light Branch Squeeze.
This one is fascinating because it involves physical changes directly impacting how you interact with major banks like Chase, Bank of America, and Wells Fargo. If you compare the traditional branch experience with this new cash-light reality, you'll see a massive difference. Traditional branches allowed walk-ins and kept large amounts of cash on hand. But right now, many banks are actively converting locations into appointment-required formats, especially in areas heavily leaning toward mobile banking. In these cash-light branches, walk-in access to large amounts of physical cash is just gone. If you urgently need more than, say, $3,000 to $5,000, you might be told to schedule an appointment several days in advance or just hand it a cashier's check. And everyday ATM limits of $500 or $1,000, that's not going to cover you if you have an urgent need for cash right now. So how do we make sure you're never left stranded? Here are some highly actionable workarounds. First off, know your specific branch's policies before an emergency strikes. Second, if you use cash for larger expenses, you've got to build the habit of planning those withdrawals a few days in advance. And crucially, maintain a relationship with a backup bank or a local credit union. That way, you always have a reliable alternative if your primary location can't meet your immediate cash needs.
And finally, that brings us to Trap 4, the Dormancy Trap.
This trap is sneaky. It silently confiscates money from rarely touched emergency funds. You see, the very definition of account activity has fundamentally narrowed in 2026. Under the old rules, if your account earned a few pennies in interest or received an automatic dividend payment, the system viewed it as active, good to go. But under the new rules at a lot of banks, those automatic transactions no longer count. Ironically, the bank no longer considers their own automatic interest payments as activity. Today, only a manual, user-initiated transaction registers as activity. So your automatic dividends, they will no longer protect your savings. And that leads us to a pretty alarming timeline. Say you have an emergency fund sitting untouched as a safety net. It seems fine at first, right? But somewhere between 1 and 3 years of no manual activity, the bank's automated system flags it as dormant. Once that happens, under state laws, the institution is actually required to transfer your funds to the state treasurer as unclaimed property. The first sign you might get is logging in to find your account frozen or already completely emptied. Yes, you can eventually get it back from the state, but it requires tedious paperwork and waiting, which is pretty useless when you need those emergency funds immediately. But don't worry, here is your ultimate escape. It's the number one manual transaction per year. That's it. It can be a tiny transfer in or out, or literally even just logging in to manually check the balance so it registers in the system. Initiating exactly one intentional action per year per account is all it takes to reset the dormancy clock and keep your money totally safe from being seized by the state. So, as we wrap up this explainer today, it is incredibly clear that the banking landscape has shifted. These automated systems, whether they're flagging suspicion for elder protection, hunting for structuring, limiting physical cash availability, or declaring accounts dormant, they are operating neutrally and exactly as they were designed to. They're just following their programming. But understanding these 4 traps is your absolute best defense. By calling ahead, keeping large transactions intact, planning your cash needs, and manually pinging your accounts, you stay firmly in control. I'm going to leave you with this final kind of provocative thought to chew on. In a new era where legal protections for banks are strengthening and automated algorithms are acting first and asking questions later, if a machine dictates when and how you can access your own savings, is your money truly yours? Take control of your financial autonomy. Look at your own accounts today with these new rules in mind. Don't get caught in the traps and keep learning. Thanks for diving into this with me.